Okay, what's going on, everybody? Welcome to a Capital Hungry weekly psychology reminder webinar. Now, this webinar is going to be particularly short and sweet, and is going to be a combination of two psychology educational webinars that are already in the vault. But this is going to be more directly talking about current events, current market volume and volatility, and how and why we should stay adaptive. But please reference the webinar getting paid for your time versus getting paid for your skill. And also reference the webinar market timing versus time in the markets. So those are two educational webinars that are already in the vault or already in the Vimeo library that touch into some more detail about some of the concepts we're going to be talking about here, except here we're more focused on current events and having these psychological reminders and what's relevant to actively going on in the financial markets right now as we speak. Because what's both very good and bad for us as manual retail traders is, one, the good thing is we are now actively a part of a shifting market cycle coming from an overheating economy, seeing years of human greed get extended and displayed in the financial markets, with various asset classes exploding in value and the rich getting richer, being a part of various fundamental catalysts such as coronavirus impact on the markets and the pandemic overall, to the Russia-Ukraine tensions, to now the shifting of tides of the central banks becoming a lot more hawkish and the impact it's having on the markets. So the good thing is we are a part of a time where, because of how much is going on fundamentally in the markets and in such a short period of time, only looking at really 3 to 4 years of all these various events happening, me talking about all the way from Trump trade war days, Brexit to current time right now, there is so much for us to learn from these market movements, from these fundamental catalysts and so forth. But the bad thing during these types of conditions, especially switching more into a bear market, and a lot of the asset classes that we know the 1%ers and the ultra rich and elite just want to keep bullish to keep extending their wealth, but they can no longer do that due to economic recession risks and as well as economic hyperinflation risks. We are seeing very volatile market conditions that can make it very difficult for scalpers and day traders to take advantage of these conditions if we do not adapt accordingly. So this webinar is about volatile markets, psychologically adapting to volatile market conditions. Quick reminder webinar on current conditions. So volatile market conditions with rising interest rates, weak economies, and high inflation, as well as majority of asset classes hitting record high prices over the last period in that 2 to 3 year bull run we are seeing a drop in market liquidity pushed by more economic uncertainty of course, inevitable rate hikes in a shifting market cycle. You can see here on this chart from Bloomberg, this is the worst time to own majority of asset classes with this average 6-month Sharpe ratio since 1991. So basically, when we're looking at this various readings here, you can see that these spike downs in negative reading here, where we are sitting at negative 2.5, we haven't been at this type of rating ratio in terms of owning assets unless we are in economic crisis territory, like in the 1990s, 2008, the initial crisis that happened before seeing that surge. Even the actual 2020 pandemic was just this little bit of a blip here before seeing a huge increase in sentiment surge of ownership in asset classes. Obviously, with that being low prices on asset classes, initial starting of raising inflation and inflation starting to go up, which increases the prices of everything within an economy, asset purchase program and support of the central bank and low interest rates, But now we are seeing very, very negative conditions, and this being the worst time to own these various asset classes since 1991 because of the shift in market conditions. Extremely high prices on all of these asset classes, economy starting to deflate and coming out of an overheating stage from lockdown period to where we are now, projections of lower GDPs, more geopolitical tensions rising and coming to the board, interest rates going up, and of course that outflow we are seeing as well. So this is why we're seeing a major outflow in asset classes. And this is more of a liquidity cycle reading here from 2010 all the way to 2022 here, right? We can see that obviously during the pandemic phase, even though we had extreme uncertainty and doubt, extreme fear in the markets, and this massive hysteria that was related to the pandemic, because of the support of the central bank, because of the low interest rates, because of the low prices that were set up on asset classes, market liquidity was absolutely surging and well above average levels, which average levels you would see very high peaks around the 40 marking grade point here, right? So you can see major regions, monthly global liquidity going into this 2022 period is starting to come back below those normalized levels and is starting to actually decrease. So we're seeing major outflow out of asset classes, major shift in economic cycle, as well as overall market liquidity starting to drop and die down as well. These are the types of conditions where you could still have high volatility in the market. And of course, if you just watched the previous webinar I did on basics of technicals, the markets are always going to be moving. There's always going to be market movement based on the innovations of technology, all of the algorithmic and machine-based trading, and all of the market participants involved. But the health of that movement is going to be very different for us as manual retail traders, where it's not going to be as clean of movement or as sustained volume and volatility compared to that late 2019 all the way to 2021, where we had the Feds flooding the markets, investors riding the wave, very strong volume, huge gains being made in the asset classes. So we had a lot more sustained movement, very easy GJ upside, for example, we are playing for that period of time. Stock market just trending bullish every single day, pullback buys, breakout buys. Gold was trending bullish as that time as an asset class. Housing market trending bullish. Oil extremely bullish and so forth. But now we're starting to get an economic shift with both the sentiment of holding asset classes and the actual market liquidity dropping as well, right? And you can also see this. Asset market booms continue for 1 to 2 years after liquidity cycle peak, which we've already had that peak really in the 2020 period, right? And now we're in 2022, and banking crisis typically occur 1 to 2 years of a liquidity cycle pass through, where now we're starting to enter that liquidity cycle trough area there, where we've had that peak take place. We've had those asset classes hit record high prices, and now we're starting to get a shift in monetary policy. The same time we're having a shift in sentiment of owning asset classes and a drop in market liquidity. So this is creating an outflow of major asset classes. Majority of asset classes as we shift cycles are seeing an outflow, with smart money holding more cash on the sidelines, and US dollar, of course, being a lot stronger as the world reserve and business currency. And this is creating more volatile market movement as we have less liquidity. So market movement is not as sustained or far more hectic. This can be deadly for retail traders, day trading or scalping, because remember, the majority of market makers, they want stock markets bullish. They want the real estate sector bullish. They want gold and their gold holdings relatively bullish. They want crypto continuing to the moon and continuing to extend their wealth gains. Not so much on the crypto, that's more of a retail perspective, but mainly when you're looking at real estate, commodities, stock market, and so forth. But as we're having that shift in economic cycle, Majority of asset classes that were extremely bullish the last 2 years on dollar weakness, oversupply of the dollar, pumping of the markets, and low interest rates and high inflation are now starting to see inverse movement and major outflow. And this outflow is not as clean as the inflow we saw, because we have, based on market psychology and investor psychology, markets trying to save as much face as possible, creating a lot of these hectic movements and dead cat bounces or aggressive wicks that you can see created on the higher time frame, as overall price is still edging down and moving to the downside as the markets adjust to that aggressive rate hike cycle coming into play. So this is what creates a lot more dead cat bounces on the stock market, meaning even if you're looking to play the current sentiment of fear, uncertainty, and doubt, more specifically looking at the stock market, even though the stock market is bearish, uncertainty and doubt is developing, we're in a bearish cycle. As a scalper or day trader, some of those aggressive dead cat bounces you see on the stock market and very volatile movement of stock market buyers trying to squeeze out a dip and push price up to more favorable price sensitivity areas to liquidate out, it can really mess up some of your trades if you're not being a lot more attentive and active with your trade management, with your exit and entries and so forth. The bullish market in stocks is always much cleaner, always much smoother compared to the bearish market on stocks. And that should make sense to everybody at this point when you understand market psychology, and that the stock market is essentially designed to increase wealth for the few at the expense of the many, right? So we're seeing market liquidity dropping. We're seeing uncertainty and doubt developing. And it's not just based on a geopolitical tension where you can go, oh, we have a war going on. Yeah, the stock market's bullish, but at least I can jump in gold buys as a safe haven. No, the economic uncertainty and doubt is due to the central banking decisions of having an aggressive rate hike cycle into economy starting to weaken. That uncertainty and doubt of raising interest rates keeps gold bearish as well, keeps oil more bearish and softer, keeps crypto markets down, keeps stock markets bearish. You're seeing an outflow in the real estate sector as well, right? So if we have this fundamental knowledge that we can confirm with the technical movement, if we can see the sporadic movement of housing or of stock markets or of crypto as it's overall making its way down, we have to adapt accordingly as manual retail traders, because we're not getting paid for our time in the charts. We're getting paid based on the quality of our skill set developed in this trading industry. And one of the skills that we need is being adaptive to changing market conditions. Is everybody following along and understanding? So this is a little bit of an informational webinar, which we've been talking about in detail every single week for a couple of months now, adjusting to the tapering talks of the central banks, the interest rate hike rumors, the actual rate hikes, the shifting of market cycle. We've been on top of this, but this is a good informative summary of that, but also more focused on how we can adapt accordingly, both from a mental, emotional perspective, as well as a risk management perspective, to make sure we protect our capital and survive in the markets, which is number one, and then potentially also make some profit during these very volatile conditions, adapting to the market sentiment accordingly. So adapting to the conditions, mental adaptation. We do not get paid for our time, but our skill. This means we must stay adaptive to market conditions and cycles. We cannot have the same approach versus high liquid, clean trending markets, especially against the market maker sentiment, which they just want to keep stocks going to the moon. Stocks only go up, stocks forever bullish. You guys have heard that many times before, right? We have to understand when stock market was bullish, oil was bullish, when GJ was trending extremely bullish, when the central banks were keeping interest rates low and dollar was bearish, this was the main sentiment that the 1%ers, that the market makers want, because that sentiment, that bias, those conditions in play were making them even richer. It was extending their wealth in commodities, in stock market, and real estate holdings and so forth. But now the conditions we are seeing are the opposite of the market makers and what they want, but the conditions are inevitable as market cycles are unavoidable. Human greed constantly has these repeating factors that we see highlighted in history with these crises that occur time and time again. So if we can have the expectations that when stock markets are bullish and stimulus is active, this is what the market makers want. Hence, we see such high liquid, clean trending movement. Then we can also have the anticipation that now the bearish market that we can see in stocks or commodities or gold or real estate is going to be a lot more corrective, a lot messier, a lot slower, and a lot more volatile compared to the smooth, clean, high volume movement you saw when stocks were trending bullish on the support of low interest rates, rising inflation, market makers riding the wave of central bank support, and so forth, right? So we have to have this mental adaptation that when I come to the charts during these volatile conditions, when economies are entering recessions, when interest rates are going up, of course, you're going to have very clean movement on something like the US dollar continuing bullish and playing that to your advantage, as these fundamental catalysts have a direct impact on keeping the US dollar bullish. But when you're trading pairs like GBPJPY or Euro JPY, or you're trading the stock market, or you're trading gold, or other asset classes that can be more negatively impacted by these conditions, then we have to have that mental adjustment accordingly that I might not see as clean, sustained movement. I might not see as high volume. I may need to take quicker jabs at the market or be more selective and so forth. Risk adaptation. We should adjust or lower our market risk in terms of taking less trades, being more selective, or risking less capital overall, where then this next slide, which is just the last slide of this presentation, is just some tips for us to adjust to these market conditions. So tips, psychological and risk adjustment tips. We have to be more selective with the trades we take, quality over quantity. When the market is trending extremely bullish and you had GJ so bullish with market optimism and UK equities extremely bullish, Japanese yen bearish, it was okay to be taking a few more trades, playing the same sentiment and bias as you're having a lot of the market movement sustained. GJ would just continue up through the intraday timeframes, have some minor pullbacks or consolidations, but continue to sustain the overall optimistic sentiment and fundamental bias of GBP strength and Japanese yen weakness, and continue to push up day in and day out. Same thing with the stock markets and so forth. But when the market liquidity is clearly dropping, we're seeing an outflow out of major asset classes. We're seeing that a lot of market movements not being sustained and in such of a quality as we saw in previous conditions when the markets were very bullish, talking about stocks and other asset classes, then we have to be a lot more selective with how much time we are spending in the markets and the quantity of trades we take, and focus a lot more, even more than normal, of quality over quantity. Less days trading. A lot of people still have this psychological need and connection that they need to trade every day, especially in conditions that we are seeing now. If you can take some effective scalps or day trades, there's no gun being pointed to your head. There's nobody forcing you to come in and trade the next session or trade the next day. More than likely, that's just your own greed, your own emotional impulsive desires, which is going to be pushing you to trade market conditions that are already difficult to trade enough, right? So it's not like making profit in these market conditions is not possible, but the risk of losing is increased. So we have to adapt accordingly. If we adapt accordingly and you decrease the amount of trades you take and you take a winning trade in the week, who's telling you that you can't stop there and stop for that day or week at that winning trade? Not risk any more commission, not risk any more stress or mental energy exerted, not risk another potential of a losing trade. You take that winning trade, you grab your quick piece of the market and you stop. And you come back another day when conditions are looking cleaner and you're feeling very confident, you have that mental clarity, you're following your trading plan, and you put that risk into the market. A lot of people, when they take a winning trade, they're just looking for another winning trade to take, another winning trade to take. They don't look at the market in a long-term perspective anymore and understand that even one winning trade a week will compound long-term more than taking 5 wins and 6 losses in a week, which a lot of people end up doing, right? It ends up becoming counterproductive. Increased mental prep before trading, where a lot of people don't do any mental prep before trading. They don't take a second to relax, to stretch, do some breathing exercises, emotionally neutralize themselves. Some people will start trading when they're right after coming from work, stressed out, tense from work. Some people will be in an argument with some family members, their loved one, their spouse or partner, and then they'll jump right into the markets, not even taking that second or few minutes to emotionally neutralize themselves and get themselves prepped for what they're about to trade. Right? Less trade positions overall to adaptive conditions, quicker jabs at the market, hard stop loss and take profit adjustment, maybe adjusting to smaller take profit ranges, maybe having a smaller lot that you're using and a larger stop loss where your risk is still the same, but you're giving your trade some more room to breathe by decreasing your lot size due to the more aggressive whipsaws, intraday ranging, and indecision that can occur when volume is lower, but volatility is still high. Adapting to market sentiment, more backtesting and analysis rather than trading. Preset expectations of more aggressive pullbacks, whipsaws, and indecision. Look for new fundamental events to play volume and volatility. Adjust to the bear market mindset, mindful of dead cat bounces, mindful that it's against the market maker sentiment and so forth. An increased appreciation for profit during these conditions, because any profit you get during these very difficult conditions to trade really highlights on your skill, right? And also, when you appreciate the profit that you're making in these conditions, it's also going to stop you from over trading, over leveraging, trying to flip your account in the singular daily period, and having more of a focus on your long-term vision, right? See a couple of questions here. So are you saying we are more likely to be more range bound or the movements not being as clean? Yes, that's exactly what I'm saying. If so, wouldn't we adapt our strategy as well? Yes, the mind adaptation is the point stated, but the strategy adaptation, your strategy is still going to be the same of the analysis you do, the confirms you look at for entry and exit, but I would adjust your risk accordingly to these conditions as it can be a lot more volatile. The risk management and mind should see some more adaptation. Your trading rules, your trading strategy, that should still be the same, as that's universal depending on whether the conditions are very poor or very good. Tony, not just now, but at all times to adapt to the market as far as your risk goes, trading frequency and mindset. Exactly. So that's what I talk about more in the time in the markets versus timing the markets webinar, as well as getting paid for your skill versus paid for your time webinar. But this webinar, I wanted to have good psychological and risk reminders with the current conditions we are dealing with, seeing that changing in market cycle and so forth, seeing that drop in liquidity and outflow out of asset classes. You know what I mean? Just a good weekly psychological reminder of current conditions at play and how we should adapt accordingly. But that's it, everybody, for this quick psychology reminder webinar. Of course, if you guys have noticed, I've been doing tons of psychology presentations that you can also rewatch as you wish. And make sure you watch those 2 webinars I was talking about that go hand in hand with the concepts stated today, and understand what's going on fundamentally, how it impacts the technicals, and how you as the manual retail trader need to adjust and adapt accordingly. All right, everybody. So unless anybody has any more questions, comments, or complaints, issues, please let me know now. Otherwise, I'm going to save and upload this, and it will be available to rewatch on Vimeo. The educational technical webinar is already uploaded on Vimeo, so you can rewatch it as you wish. This will be uploaded shortly. James, I just talked about that. We're seeing that was the first 2 slides. You should also rewatch the other market update webinars, trade idea webinars, where and even a lot of the informational posts I send in banter in the chats about dropping market liquidity, decreasing market liquidity, increasing market fear and uncertainty, increasing volatility, outflow out of asset classes. That is how the market makers are adjusting accordingly to the changing conditions, which I also talked about in the podcast done over the weekend as well. I don't want to be rude, but I think I'm doing way too much for people to keep up. But that's why these webinars are always saved and uploaded, where if you go put that effort in yourself, you can catch up on all this information. But the markets are never going to stop, and I'm never going to stop either. I'm just going on with what's going on day in and day out. I already have a very great understanding of the previous concepts. That's why I do the educational webinars on those concepts, right? But for anybody who's been keeping up, especially a lot of the OG members, you know that this rate hike change, this rate hike cycle change, this outflow out of asset classes, we haven't just been tracking. Your boy here has also been predicting it, have I not? About we're going to see a bear market on stocks, crypto market crash, housing market correction, aggressive rate hike cycle, and the change in market sentiment and so forth, right? So I'm doing my best to predict these things, but then also document it and explain it in detail for everybody to follow along and understand. But of course, it's going to be very intense because the markets aren't stopping. Every day there's going to be new information, every week, every month, new events that we have to stay on top of. You know what I mean? So all I need all of you individuals to do is those webinars that I do, please watch them once, watch them twice, take notes, at least to keep up, at least to have an understanding of what's going on and why. I know I've been coming out with a lot of content. It's very intense, but it's not like the price of Capital Hungry has gone up. You guys are still paying the same price. You're just getting more information that's beneficial for you at the end of the day. But I can't force you to watch, to learn, or to understand these things. Me, I'm going to be good at the end of the day. Everybody understand? This webinar also, why do you think I haven't traded yet this week? Or after that great successful month I had, I'm taking a break. You haven't seen me explain that when I said, yeah, we could still scalp and take some scalps, but for day trades, I haven't really seen anything as clean for me. I'm waiting for a lot more cleaner conditions, and I'll take my day trade, take those 1 or 2 trades and be done. Right? That's just me doing what is explained in this webinar just in a bit more detail alongside the other educational webinars, you know? But yeah, you guys have a lot to watch this weekend. Just follow along in the main feed, trade room, ask members in banter, Vimeo. You can even sort the Vimeo videos by upload date. But all right, I'll see everybody later in the afternoon, later in the evening for our weekly recap.